I am pleased to introduce the chair of the Federal Deposit Insurance Corporation, Jelena McWilliams. McWilliams was confirmed on May 24th, 2018 as the 21st chairman of the Federal Deposit Insurance Corporation. Prior to that role, she was Executive Vice President, Chief Legal Officer, and Corporate Secretary for Fifth Third Bank in Cincinnati, Ohio. She graduated from the University of California at Berkeley with a Bachelor of Science degree in Political Science and earned her law degree from the University of California at Berkeley School of Law. Please join me in welcoming Jelena McWilliams.
So that felt like Wizard of Oz. There's a curtain and I show up. Don't expect miracles. Thank you for having me again this year. I am grateful to the St. Louis Fed for hosting this conference, CSBS under John Ryan's capable leadership, as well as my staff. Where's my staff? Thank you, guys. Thank you. I know Governor Bowman spoke this morning, and I know I have big shoes to fill, so I'll have to ask her what shoe size she wears next time I speak after her. When I addressed this conference last year, I had served in my role as FDIC chairman for about 4 months. And so I'm hoping that this year you get an improved version of a keynote speech if you don't get a better speaker. And if I fail, you'll have to invite me next year again. Last October, I discussed at this conference FDIC's efforts to strengthen trust among the agency, other regulators, the public, and banks through transparency and accountability. I explained that transparency is pivotal to maintaining trust in the safety and soundness of the entire banking system. As I pondered potential topics for this year's conference, my thoughts kept coming back to a simple question. Why do we do what we do, we being the regulators? At both the state and federal level, regulatory agencies have their missions. We implement these missions through multiple regulatory, supervisory, and enforcement channels. Not to oversimplify the critical and often complex work of our regulatory agencies, but once we fulfill those basic missions, we should ask, why do we do what we do? The FDIC was created in 1933 to protect bank depositors and ensure a level of trust in our banking system as our nation emerged from the Great Depression. In order to ensure that public trust in our financial institutions exists, we have to make sure that banks are safe and sound. The basic tenets of safety and soundness focus on capital, liquidity, assets, bank management, earnings, and the bank's ability to manage risk. A safe and sound bank is able to withstand market shocks and survive. It is the ability of banks to survive that is the focus of my speech today. To illustrate what I mean by survival, I will highlight a story of a company that was once a behemoth in its industry. Because I have been told by all of my lawyers not to mention any bank by name, this story is not about a bank. It is, in fact, about Blockbuster. Full disclosure, I used to work a closing shift at Blockbuster during my college years. And one of the perks of the job was getting free movie rentals, but if you don't own a VCR, that doesn't mean a whole lot to you. Blockbuster had thousands of retail locations, millions of customers, a sizable marketing budget, and a successful business model. In 2000, a little startup proposed a deal to Blockbuster. The startup would run Blockbuster's brand online, and Blockbuster would promote the startup's mail order rentals in its store. Blockbuster declined. It also declined an opportunity to purchase this small startup for $50 million. You know where I'm going with this story. Blockbuster has since filed for bankruptcy. The one remaining store in Portland, Oregon is a vestige of a bygone era. Meanwhile, the little startup helped usher in the era of online streaming, has a market cap over $100 billion, and serves more than 100 million subscribers, including probably many of you in this audience. And just out of curiosity, how many of you use Netflix? Congratulations, you killed Blockbuster. There are numerous case studies dissecting why Blockbuster failed, but the angle I would like to explore today is innovation. At the risk of oversimplifying, Blockbuster was not quick enough to adopt, perhaps even understand emerging trends. And this will really age me and tell me who in the audience was born after mid-1980s. Just like video killed the radio star. Thank you. For all of you that didn't laugh, we could say that new, more convenient delivery channels put Blockbuster out of business. But it was not mail-order DVDs or streaming per se that killed Blockbuster. It was Blockbuster's inability to recognize an emerging trend and adapt to it. In his 1996 book, The Road Ahead, Bill Gates wrote, "People often overestimate what happens in the next 2 years and underestimate what will happen in 10. And by coincidence, there's a great documentary about Bill Gates on Netflix. Technology and innovation had been transforming financial services long before smartphones and machine learning became frequent topics at banking conferences. From the development of double entry accounting and the first stock exchange to the more recent innovations brought about by ATMs and internet banking, financial innovators have worked for centuries to improve access and better serve customer and industry needs. The speed and breadth of technological innovation in recent years, however, marks a shift from earlier eras. Advances in payments, credit, and funding, to name a few, have tremendous potential to transform the business of banking as we know it, both in the way consumers interact with their financial institutions and the way banks do business. Now more than ever, it is crucial that we understand the impact, scope, and consequences of what we have come to call fintechs. When Bill Gates made that statement in 1996, the FDIC was actively thinking about the changes that technology would bring to financial services. We were focused on electronic banking. By year-end 1997, 602 out of 6,117 FDIC-supervised banks operated internet sites. That was less than 1/10. 34 were transactional sites that provided customers the ability to pay bills, transfer funds, and open accounts. The others were information-only sites that described the bank's products and services. The FDIC's 1997 annual report observed that while institutions on the internet represent a small segment of all financial institutions, acceptance of the new technology by consumers and financial institutions is increasing rapidly. Since 1997, the pace of technological change has continued to accelerate. In the late 1990s, who among us would have imagined being able to deposit a check with a computer we carried around in our pockets? And even more so, who would have imagined that you're going to pay $1,000 for that small computer? Yet that was the reality 10 years later. A few years after that, that same computer was serving as a point-of-sale device that allowed micro-vendors to access the payment systems, and voila, you might have applied for your last mortgage wearing pajamas. Raise your hand if you did. Shame on you. Technology continues to advance at a relentless pace. I did too, so don't worry about it. And we must challenge ourselves to think about what that means for the future of the banking industry and community banks in particular. Many have speculated about what the future of banking holds. Just a few years ago, some predicted that technological advancements and the rise of fintech firms would lead to the demise of the banking industry. However, the last few years have shown that fintechs and banks have learned to coexist and often prosper through partnerships. Fintechs bring new technology and speedy delivery to the table, and banks bring deep customer experience, access to the payment systems, relationships, and of course, deposit insurance. Current predictions about how could technology transform the banking industry fall into a handful of broad categories that will affect how fintechs and banks partner in the future: digitization, data access and open banking, machine learning, artificial intelligence, and personalization. Consumers are increasingly demonstrating a preference and expectation for digital lending and deposit platforms. As a result, many banks are now offering these services, sometimes through a separate division and trade name. Digitization can lead to efficiencies for banks by reducing the time needed to make lending decisions and by improving a lending department's capacity to manage and administer loan portfolios. At the same time, it can improve the loan application process for consumers, reducing the amount of application data they need to enter and often leading to faster credit decisions. The key customer-centric features of digital banking are affordability, convenience, and instantaneous access to information. These features help consumers understand their financial standing in real time, as well as plan for long-term goals and unexpected emergency. They also allow financial institutions to reach unbanked and underbanked customers and communities who increasingly have mobile or online access to services. The adoption of mobile banking is a great start, but consumer expectations for a truly digital experience continue to grow. Banks must evolve with these expectations, and their technology service providers must evolve as well. Existing core processing systems typically provide a number of different platforms for lending and deposit-taking activities. These platforms may use differing data standards and may not interact with one another, let alone solutions from other companies. Consider a future where next-generation core service providers offer an end-to-end digital banking experience to their partner banks. These future core providers will develop their own innovative solutions for their financial institutions' clients. But they will also allow institutions to develop their own technology or partner with Fintechs, all while providing flexible access to the data on the core providers' systems. These shared data and software interface standards will support a marketplace of innovation, technology, providing creative freedom to banks and new products and services for consumers. We're not there yet. Beyond the products and services they offer, digitization will also change how banks operate. Taking advantage of technology will transform back-office operations and will demand new skills from a bank's workforce. Increased digitization also comes with important considerations related to security and resiliency. Banks must embrace these benefits and challenges to stay relevant in an even more competitive market for customers. Some consumers are increasingly interested in sharing their financial account data with third parties. Every time my friends post on Facebook or Instagram that they're going on a vacation and where they are, I just shake my head thinking your house is empty. And the world knows it now. These companies, including Fintechs, provide personal financial management, budgeting, savings, and other services. The firms may use this customer-permissioned data to verify account information and loan applications or to evaluate creditworthiness, and these are just a few examples. This concept of customer-permissioned data sharing is often referred to as open banking. Data is the new capital. Financial service providers are using data and technology to develop new services for consumers. These providers often rely on data aggregators to consolidate a customer's financial information from one or more institutions. The data aggregator can then present the consolidated information in a user-friendly format to these service providers. Consumers clearly benefit from the innovation and competition that open banking fosters. But these benefits do not come without costs. Customer permission data sharing raises a number of questions regarding data ownership, privacy, security, liability, and consumer control. As with many emerging trends, stakeholders have expressed a preference for addressing issues such as these through industry-led efforts rather than regulatory intervention. Surprise. For example, a popular method of data aggregation called screen scraping has raised many concerns, particularly related to information and identity security. This is because customers enable screen scraping by providing login credentials for their bank accounts, including their IDs and passwords. There appears to be broad consensus within the industry that APIs and tokenizations are a better method to facilitate data sharing to avoid the risk associated with screen scraping. Developments that allow data access and open banking while ensuring security, safety, and soundness, and consumer protection hold a great deal of promise to enable further innovation in the financial services marketplace. With the amount of data being created, as well as advances in computing power, data is increasingly being leveraged by fintechs and financial institutions to create new insights and monitoring tools using artificial intelligence and machine learning. The use of machine learning is growing in models used by financial institutions and technology firms alike. These models can help banks make credit decisions, detect fraud, and improve customer experience, to name only a few. Existing principles-based guidance, such as the Interagency Guidance on Model Risk Management and the FDIC's Guidance on Managing Third-Party Risks, serve as a foundation for managing risk associated with these models, but we can do more. These guidance documents do not carry the force of law, but describe a framework for institutions to manage and mitigate risks associated with the use of models and third-party vendors. The depth of risk management practices needed to mitigate model risk depends upon the materiality of the activity being modeled or services being provided. Artificial intelligence and machine learning has also been used to leverage alternative data for a range of purposes, including for credit decisions. This alternative data generally includes information not typically found on credit reports or customarily provided by customers. If used appropriately, alternative data has the potential to help demonstrate the creditworthiness of consumers who currently may be unable to access credit from banks, or to enable consumers to obtain more favorable products and pricing based on more accurate assessments of repayment capacity. The regulators should be open to this. When deploying AI ML tools, an institution must consider many factors, beginning with the level of workforce expertise needed to manage the capabilities. The transparency of these models and the ability to interpret and understand their results is vital to ensure compliance with regulatory obligations. Properly managed artificial intelligence and machine learning can help institutions better understand their customers and their operations. Consumer expectations are propelling this explosive growth in technology. Consumers expect convenience and a 24/7 connection to their financial services providers. Experts predict that this demand will only increase with time, as well as the demand for personalized services. Mobile and internet banking allows consumers to conduct banking activity at any time and from any location. Where's the lady who had a mortgage opened from a... Thank you. And chatbots allow institutions to interact with customers and answer questions they may have about these transactions. Through advanced data analysis, institutions can offer customers better tools to manage their financial lives. These tools can also provide banks with a better understanding of the financial products and services their customers need, a win-win for both the customer and the bank. Now, it would be easy just to say, banks, if you do not innovate, you will lose in the long run. But banks know this. Customers often demand the latest products and services that they have seen their friends use or that they may have seen featured on social media. For the most part, banks would like to meet and even exceed customers' expectations. That's how they stay in business. So if that is the case, then why are more community banks not developing new technologies? For two principal reasons, in my opinion. One is cost, and the second one is regulatory uncertainty. The cost to innovate is in many cases prohibitively high for community banks. They often lack the expertise, the information technology and research, and development budgets to independently develop and deploy their own technology. That is why partnering with a fintech that has already developed, tested, and rolled out new technology is often a critical mechanism for a community bank. The business case for collaboration with fintechs is clear. Fintechs are built on a digital infrastructure that can develop and offer consumer products quickly and with requisite agility as consumer demands evolve. Banks have a built-in customer base and understanding of regulatory requirements, access to the payment system, and deposit insurance. A few months ago, I met with 2,000 fintechs in Silicon Valley and San Francisco to learn how they team up with banks. For the most part, the FDIC does not regulate these entities. But I was eager to gain their feedback for a simple reason. If our regulatory framework is unable to evolve with technological advances, the United States may cease to be a place where ideas become concepts and those concepts become the products and services that improve people's lives. The challenge for the regulators is to create an environment in which fintechs and banks can collaborate in a safe and sound manner. It is my goal that the FDIC lay the foundation for the next chapter of banking by encouraging innovation that meets consumer demand, promotes community banking, reduces compliance burden, and modernizes our supervision. This is not optional for the FDIC. We must lay this foundation because the survival of our community banks depends on it. These small banks face challenges from industry consolidation, economies of scale, and competition from their community bank peers, larger banks, credit unions, fintechs, and a plethora of other non-bank lenders. While the FDIC has limited ability to address the direct cost of developing and deploying technology at any one institution, there are things that we can do to foster innovation across all community banks and to reduce the regulatory cost of innovation overall. We cannot sit on that proverbial regulatory perch and observe the change from above. We have to get on the ground, roll up our sleeves, and get to work on supporting and advancing scalable technological change that works for community banks. The FDIC is a link in the community bank ecosystem, just like banks' customers and their communities. As the primary regulator of most community banks in America, we have a responsibility to ensure that our regulatory framework supports innovation in a manner that is accessible to community banks and responsive to ever-changing technological demands. FDI Tech will do just that. The FDIC Tech Lab, FDI Tech, will collaborate with community banks on how to deploy technology in delivery channels and back office operations to better serve customers. Many of the institutions we supervise are already innovating, but a broader adoption of new technologies across the sector will allow community banks to stay relevant in the increasingly competitive marketplace. First, we can reduce the regulatory cost to banks of developing and implementing new technology. It is our job as a regulatory agency to understand technology by engaging with innovators in banks and at Fintechs, and to provide sound guidance and technical assistance to banks that choose to deploy new technology. My goal is not to replace the business judgment of banks, but to identify and eliminate unnecessary regulatory burdens that discourage innovation. Whether banks choose to develop technology on their own or partner with a fintech, the FDIC will work with them to identify and address unnecessary regulatory impediments. Through engagement and technical assistance, we can help eliminate the regulatory uncertainty that prevents some banks from adopting new technologies. Second, through tech sprints and other innovative approaches, the FDIC can help encourage the market to develop technology that improves the operations of financial institutions and how the FDIC functions as a regulatory agency. Tech sprints are designed to challenge innovators, technologists, coders, engineers, developers, and subject matter experts to develop technological solutions to address specific industry or regulatory challenges in a competitive team environment. Tech sprints are not a new tool, but the FDIC can use these events to motivate the development of technologies that address challenges beyond the capacity of any one institution to solve. These public-private partnerships can also help promote market-based solutions that may not have been obvious to any one participant. We're also considering other tools, such as prize competitions and rapid prototyping, to help promote private sector development of innovative solutions to supervisory challenges. These strategies for developing new RegTech and SupTech solutions will encourage innovation and problem-solving more quickly and at less cost than traditional government contracting. They will incentivize the private sector to produce market-driven solutions that will help transform the FDIC. These tools may also help institutions that voluntarily adopt them to become more efficient in their operations. These efforts will encourage non-traditional partners to engage in the development of cutting-edge technology for the financial services industry, and will help avoid the limitation of monolithic, government-imposed technological mandates that are too expensive and out of date by the time they are developed. Third, the FDIC can work with developers to pilot products and services for truly innovative technologies. Working with our partner regulators at the state and federal level, and with the institutions themselves, our goal will be to build compliance into the pilot, considering regulatory questions or impediments as they arise, and then working to address them together. Once a pilot is completed, we will work with the institution and its partners to understand and publish the results, what worked, what did not work, and how to make any necessary adjustments to make the product or service better once it is scaled and deployed. Over the coming months, the FDIC will play a convening role to encourage community bank consideration of how technological developments could impact their businesses, and to ensure community banks' perspective is considered in industry-led efforts to establish standards. The FDIC will host a series of community bank-focused stakeholder roundtables on digitization, data access and ownership, machine learning, and artificial intelligence, and personalization of the banking experience. We will invite a mix of community banks, technologists, and technology service providers to these discussions. This task will not be easy, and people will be the key to its execution. We're currently searching for a Chief Innovation Officer. I didn't come here just to give a speech. To lead our tech lab. The CINO, it comes with a cool acronym, will work across the FDIC and with our U.S. and international partners to create a regulatory environment that increases the velocity of transformation and removes unnecessary impediments to innovation. We're also looking for staff with the technical expertise to help us better understand technology already deployed at our banks, develop new supervisory tools to be more effective and efficient as a regulator, and secure our network and ensure that our supervised institutions' networks are also secure. By promoting these developments and encouraging our FDIC-supervised institutions to voluntarily adopt a more advanced technological footing, we can help foster the transformation of the community bank sector. In turn, the institutions we supervise can reach greater efficiency with products and services that are more attractive to their customers. Ultimately, These advances will allow the FDIC to use a new regulatory approach to supervision powered by the same technology that is revolutionizing the banks we supervise. We have already begun this process. For example, we have been exploring ways to leverage technology at our examination program. In 2019, technology enabled us to conduct an average of 64% of our consumer compliance examinations and 44% of our prudential examinations off-site. And as we train our examiners more on the use of these techniques and incorporate more new technology, we will further cut the costs of our exams on institutions without compromising on their quality. To build on these efforts, earlier this year, we established a subcommittee on supervision modernization to consider how the FDIC can further leverage technology and refine processes to improve our examination. Subcommittee members include representatives from banks, large and small, technology companies, and other thought leaders in the private sector and academia. They have met 3 times this year, and I'm very excited to see the subcommittee's recommendations to make our supervision even more efficient, transparent, and accountable. Shortly after becoming FDIC chairman, I went to a small community bank to open a checking account. I wanted to experience firsthand what consumers across the country experience when they visit a community bank. I drove away from Washington and entered a branch of a small bank. Community banks are characterized by their customer relationships, and my visit was no exception. I was greeted with a smile and an offer of candy. While the patient branch manager went through the requisite paperwork to open my account, a customer walked in with his 3-year-old daughter. Mary ran up to the teller to give her a hug. The father said that Mary insisted on stopping by the bank to say hi. The bank manager smiled and told me she has been coming here since she was born. It felt just like a Norman Rockwell painting. Then, the branch manager went to an IBM typewriter, removed the dust cover, typed up my new account card, and laminated it. As she handed me, she didn't know I was the FDIC chairman. As she handed me the fresh from the laminator card, she said, "Be careful, it is hot." And with that, Norman Rockwell left the room. And I could not help but remember that last time I had a laminated card with my name and account number on it, I was at the Blockbuster. Small banks like that one are slowly disappearing from America's landscape. Based on 2018 summary of deposit data, 627 counties are only served by community banking offices, 122 counties have only one banking office, and 33 counties have no banking offices at all. I have noted on many occasions how vital community banks are to their communities. They support the small businesses, farms, libraries, and other entrepreneurs that help small towns, rural communities, and inner-city locations stay economically relevant and even thrive. If our community banks are unable to adapt to innovation that is sweeping their industry and which their customers have grown to expect and demand, small banks will simply not survive. I do not profess to know what the right number of banks in the United States is, but I recognize that community banks have to be competitive in order to survive. And as I ponder, why do we do what we do? I inevitably reach the same conclusion over and over again. We do what we do to make sure that small banks across this great land can survive. In the soybean fields of Missouri, in the cornfields of Iowa, next to the cattle ranches of Texas and the potato farms of Idaho, up and down the San Joaquin Valley in California and in the fishing towns of Maine, and everywhere in between. The FDIC stands ready to take on the challenge of innovation and to create a regulatory environment that will make it easier and more cost-inducive for small banks to adopt new technologies and thrive. Together, we can ensure that Mary's daughter, future daughter, can still work with a local banker that knows her community, even if that hug is virtual. Thank you.
So how many, okay, I'm going to put my age out there, I think, by asking this question. So how many in this room have millennial children? Would you raise your hands? Quite a few. How many of you are millennials? A lot of old people in this room. So a couple quick stories to build on that speech, but I think you will relate to this if you have millennials. So first, there's my 32-year-old who didn't get married till 30, who just bought a house at 31 and First kid will be at 32. So that's part of it, the positioning. But the house, guess where he got his mortgage? An online mortgage company. Because that's just what millennials do, is they sit in their pajamas, I guess, and do their banking. So then I've got my 25-year-old. She just moved from, well, she's been in school. She's off my payroll, so I'm really excited about that. That's really great. She has a job, and just recently made the big decision that she would move her accounts to where she now lives, which is in Minnesota. Anybody here from Minnesota? Oh, I can't do you. Oh, okay, you betcha. Yeah, anyway, I got that one done. So I don't know if you'll like the story or not, but here's what she said. Now remember, she's 25. She doesn't have a lot of money, right? So, but she has $10,000, which I actually think is not bad for a 25-year-old. And she said, but I think I should move this because if I do have a problem with my banking account, I want a local bank to be able to go in and just get things fixed. But I don't want to move my savings because this local bank that's near me pays very little. So my friend Mary uses an online bank for her savings, and they pay I think as this was in the car, 2.56%. So I'm going to take the $10,000 and put it in the online bank. Do you want her as a customer? She's going to be really expensive if all she does is her little bit of business. But I think that is a good reflection on how some of the different demographics in our society are thinking. 90% of millennials have a smartphone. It is a different way of doing business. I know we've been doing an Ask the Fed series on fintech this year. I hope all of the bankers in the room have participated in that. I think we've covered a lot of these basics, at least definitionally. But I've also seen how difficult it is in different areas of the country. So Julianne Thurlow, I'm not sure, one of our speakers, are you in the room, right? Is she raising her hand? Oh, over here, yeah. So we were on the East Coast, and you guys just said, we have to do this, and we have it now, and you were just talking about everything you have underway. As I go to other parts of the country, the discussion is muted. There's almost no demand for implementation of financial technology. So what a challenge for everyone in the room. How do you ensure that you engage that generation that demands the services while many in your perhaps more senior generation still want that very personal place-based touch? There's going to be a small amount of challenges, I think, in the years ahead as we begin to manage those challenges. But I will leave you with this, which is I had a group of my staff members, we were working on strategic plans, and they said, we need to develop fintech expertise in a few people so we get this right when we see it in the banks. And I said, no, you need to develop fintech expertise in every examiner on this staff because every examiner will see it in the bank, and you all need to be equally capable of understanding what it means and how to calibrate it.